Turkey's central bank has kept its policy rate, the so-called one-week repo rate, unchanged at 14%, completely in line with expectations. The decision was announced after the first monetary policy meeting of the year. Looking ahead to the next 12 months, foreign banks expect the central bank to keep interest rates stable. In particular, UniCredit forecasts that the bank will avoid a decision that will trigger the depreciation of the Turkish lira. And Bank of America also expects the policy rate to remain constant until at least the end of the first quarter. Treasury and Finance Minister Nureddin Nebati has said inflation would reach its peak in January, adding, though, that there will be a decrease in May thanks to a global pickup in demand, but also a decline in food and energy prices. Now, for more on this, let's now go to Taha Arvas, Adjunct Professor of Finance at Boğaziçi University. Taha, many thanks for being with us today. First of all, I mean, you've heard what we said about the bank's predictions in terms of the monetary policy. Do you agree? And if so, what's the rationale behind it? Can you explain?
I do. And some of the reasons include the other news points you just mentioned, these multi-decade highs in inflation globally. Australia, as we just talked about, how they're going to stop quantitative easing. All these central banks globally are now moving away from quantitative easing and potentially moving towards quantitative tightening. We may see that begin in the United States in March. Tapering has already begun. And this means everything is in flux. That means policymakers, central bank governors are really just holding firm, not changing, trying to not change policy at all. They've already implemented a step in which people who have Turkish liras will be guaranteed a return on those liras and pegged. The lira isn't pegged to the dollar, but their return will be. So if you hold on to the Turkish lira and invest in these government savings accounts, you're not going to lose money against the dollar. Is the plan from the government? So if all these things hold, the central bank won't have to change their policy rate in the near term to shore up demand for the lira. Interesting,
Taha. So for now, stable interest rates here, whereas on the other side of the Atlantic, I mean, investors really are expecting a more hawkish Fed to the point they're pricing in 4 or some even 5 hikes this year. And I mean, I'd like to ask you, what's the impact of this more hawkish Fed and possibly a stronger dollar on the Turkish economy? And I'm speaking about stock markets, capital markets, but also the real economy.
Right. I mean, you know, the saying, when the Fed sneezes, the world catches a cold. So what's going to happen now is there's going to be a major demand, not major demand, but there's going to be an increase in demand for U.S. dollars globally. And this means a decrease in prices in commodities like energy, which Turkey is an importer of. Essentially, it's going to impact everyone globally, these moves. But the problem is all these economic terms we talk about, or economic predictions, they all preface with the words, all else being equal, ceteris paribus, but we're in the midst of a pandemic, so everything is in flux. So it's very difficult to predict what's going to happen. But everything else equal, if the dollar increases, if interest rates in the United States increase, then the dollar will increase globally, and commodity prices should decrease, which should help countries with stable currencies.
Very interesting, Taha Arvas. Many thanks for your analysis today.